There are four general different types of bank accounts: checking accounts, savings accounts, money market accounts, and certificates of deposit. Let's start with checking accounts. Checking accounts. A checking account is like your main account. It lets you write checks, use ATM cards and debit cards to withdraw money anytime, and make automatic/online bill payments. Most checking accounts don't pay any interest. However, some banks may pay small interest on checking accounts with a larger balance. Remember, we talked about interest in a previous video. Money a bank pays you for putting your money in an account with them. Next, we have savings accounts. Savings accounts. A savings account is generally used to set money aside for future use. It is not an account typically used for day-to-day purposes, and many have limitations on how many withdrawals can be made in a month. However, savings accounts generally pay a good amount of interest depending on the current interest rates. For example, right now I have a savings account that pays me about 4% of interest on my account per year. This means that if I have $1,000 in my account right now, after 1 year I should have $1,040 in my account. If I have $10,000 right now, then that becomes $10,400 1 year from now, an extra $400. You may be wondering how the bank is able to give you free money. Simply put, the bank may give you 4% of interest for giving them your money and use your money to charge 7% interest on a loan that another person takes out from that bank. Then we have money market accounts. Money market accounts. Money market accounts are similar to savings accounts, with the only difference being what the bank can do with the money. In some banks, money market accounts may have some restrictions and often carry higher interest rates. Lastly, we have a certificate of deposits, or CD. Certificate of deposits, or CD. Certificates of deposit are used to put money aside for a longer period. CDs are issued for a different duration called a maturity period. Maturity period. This could be 3 months, 6 months, 1 year, etc. In a CD, you can't withdraw your money until the end of the maturity period. They typically pay higher interest rates than savings accounts and don't have any fees. We can see that in general, the longer you keep your money in an account, the harder it is to get money out of your account, the higher the interest/returns. And in case you're wondering what happens to your money in case the bank fails, generally, every account in all these accounts is protected by federal insurance up to $250,000.